Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Bloom Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps the channel grow.
Absolutely. And to just give you some quick context before we really get into the weeds today, I want you to imagine something. Imagine you just spent like billions of dollars building the most advanced AI data center on the planet, right?
Right.
You've got the fastest chips, you have these state-of-the-art cooling systems, everything is perfect. But when you go to actually plug this massive facility in, the local power grid operator just looks at you and says, sorry, we won't have enough electricity capacity for you until, 2029.
Wow. Which is, that is the exact nightmare keeping tech CEOs awake right now.
Precisely. Data centers simply cannot get enough power from the aging traditional electrical grid. It's a massive bottleneck facing the entire artificial intelligence industry. And Bloom Energy is just surging right now because they've positioned themselves as the premier infrastructure play to solve that exact problem.
Got it.
And actually, before we go any further, if you're tracking these kinds of massive tech swings, I want to quickly mention VIP Algos. The link is below in the description. It's a TradingView indicator suite.
Right, for visual buy and sell alerts.
Exactly. Visual alerts, trend direction, support and resistance levels, and like your TP and SL planning. It's a great tool, but we do have to emphasize it is an educational tool only.
Yeah, definitely not financial advice.
Right, not financial advice. It doesn't guarantee profits, and it does not place trades for you. Trading involves risk, so always do your own research. And just a heads up, it is an affiliate link that earns us a commission at absolutely no extra cost to you.
All right, let's move into the wealth building context. When we talk about building long-term portfolio growth, we really have to look at how a company fits into the bigger macroeconomic picture.
Mm-hmm.
And right now, obviously, there is no bigger picture than the AI infrastructure supercycle. But looking at Bloom Energy, I have to play the skeptic for a moment here.
Sure, go ahead.
We've seen so many tech startups basically just slap the letters AI onto their marketing materials, and suddenly, their stock jumps 30%.
Yeah, the hype is real.
Exactly. So is this just another speculative short-term momentum trade that's riding the coattails of the AI hype? Or is there a genuine foundational wealth-building story here?
Well, it is absolutely a valid question, especially with how wild some of these, AI-adjacent stocks have been acting lately.
Yeah.
But when you actually look closely at Bloom Energy, it fits a very distinct multi-year compounding growth profile.
Oh, okay, how so?
You basically have to separate this from the software side of AI. Like, this is not a software company selling high-margin digital subscriptions. This is a heavy industrial story. They're building the physical, tangible power generation units that quite literally keep these billion-dollar AI data centers from going dark.
So it's about laying down the actual concrete and steel required for, the next decade of computing.
Exactly. You're investing in the picks and shovels of the AI gold rush.
Right.
But in this case, the picks and shovels are, highly advanced off-grid power plants.
Right.
And because of the massive backlogs they're building, combined with incredibly high switching costs for their customers. Because, once you install a massive power server, you don't just swap it out a year later.
Oh, of course not.
Right. So this is fundamentally a story for investors with a longer time horizon. It's for those who can stomach some intense volatility along the way to ride out a massive multi-year industrial shift. The whole math of their business is transforming. Now let's look at the fundamentals, because the numbers we're seeing here represent a major structural inflection point in their revenue and earnings trajectory. Let's unpack the first quarter of 2026. Revenue hit $751.1 million.
Wait, 751 million? Which is just a massive leap. That's what, a 130.4% year-over-year growth rate?
Right. Just to put the scale of that into perspective for you, it is the first quarter in the company's public history where they achieved greater than 100% growth.
Wow.
Yeah, they more than doubled their business compared to the exact same time last year.
And it wasn't just top-line fluff to impress the market, right? They actually swung to profitability. Net income hit a positive $70.6 million. That is a total 180-degree turnaround from, I think it was a $23.8 million loss in the same period the year before. And earnings per share came in at $44, which absolutely crushed the Wall Street consensus. They were sitting way down at 12 cents and 12. But here's the obvious question, and I'll call it the capital question.
Okay.
How does a hardware-heavy manufacturing company fund 80% annual revenue growth without either drowning in crippling debt or, diluting their shareholders to death by issuing a mountain of new stock? I mean, we see hardware companies scale themselves into bankruptcy all the time just because factories cost money.
Yeah, that is usually the fatal flaw for industrial hypergrowth. You grow so fast, you literally just run out of cash.
Mm.
But this is where Bloom's specific business model shines. They use what they call a fast payback factory model.
Okay, what does that actually mean in practice?
What that means is they've completely standardized their manufacturing process. So
Okay.
instead of custom engineering every single deployment, they're essentially just stamping out modular blocks of power.
Hmm.
To build 1 gigawatt of new manufacturing capacity, it only costs them between $100 million and $150 million in capital expenditure.
Okay, but how quickly does that new factory start actually paying for itself?
Well, because demand from these data centers is so ravenous right now, they recoup that entire $100 to $150 million capital expenditure in roughly 6 months through immediate sales.
Wait, 6 months?
Yeah, 6 months.
6 months to pay off a manufacturing facility? That's incredibly fast capital velocity. I mean, it completely changes the math of the business.
It absolutely does. It allows for self-financing growth. They make the money back so fast they can just roll it right into the next expansion. In fact, their CEO, KR Sridhar, explicitly came out and stated they do not need to issue more stock to fund this expansion.
Wow, for institutional investors, hearing that there won't be massive equity dilution is just absolute music to their ears.
Oh, for sure. Plus, they have a $20 billion product backlog as of the end of 2025. That backlog is up 2.5 times from the prior year, so it gives them this phenomenal multi-year revenue visibility.
But let's talk about the moat for a second, because a $20 billion backlog is great. But if this is so lucrative, what stops a legacy industrial giant from just reverse engineering their tech, undercutting them on price, and stealing those customers?
Speed. Their killer advantage is speed to deployment. This is the core of their solid oxide fuel cell technology. To understand why this is a moat, you have to understand why the traditional grid is failing tech companies so badly right now.
Okay.
Right now, if a hyperscaler wants to build a new AI data center, they need a full gigawatt of power. The utility company can't just flip a switch. They have to upgrade aging transformers, build new substations, and run high-voltage transmission lines across miles and miles of land.
Right, which takes forever.
Exactly. It requires years of environmental impact studies,
Yeah.
zoning approvals, and just waiting in line for backlog transformers. That pushes their timeline out to 2029 or later.
So the grid just physically and bureaucratically cannot handle the load.
Precisely. So Bloom Energy basically bypasses the grid entirely. Their fuel cells don't require high-voltage transmission lines. You lay a commercial gas line, so natural gas or biogas, to the site, and the fuel cell uses an electrochemical reaction to generate electricity right there on the spot without combustion.
Oh, wow.
Because of this, Bloom provides a 100% off-grid solution that can be deployed in as little as 90 days.
90 days versus waiting until 2029. I mean, when you are a tech giant in an absolute arms race to dominate AI, waiting 3 years for power means you lose the war entirely. That speed is a massive economic moat. That brings us to the catalyst timeline. If they have this incredible 90-day speed advantage, let's look at what is actually coming down the pipeline that could move the stock next.
Yeah, so the most immediate event is the Q2 2026 earnings report, which is expected in late July or early August. Given the massive beat we just talked about in Q1, management sharply raised their full-year guidance. They're now projecting revenue between $3.4 billion and $3.8 billion for the year.
Which is roughly 80% growth at the midpoint.
Exactly. Consensus estimates on Wall Street are going to have to be heavily revised upward to account for this new reality.
And beyond just earnings, there are some significant macroeconomic tailwinds at play here too, right? Like, we've seen a recent U.S. tariff reduction on steel and aluminum derivatives. The tariffs dropped from 25% down to 15%.
Which is huge. It's massive for a company building heavy, metal-intensive hardware. I mean, a fuel cell server is essentially a highly sophisticated metal box housing ceramics and rare metals. That 10% reduction in raw material tariffs drops straight to the bottom line, directly lowers their cost of goods sold, and improves their manufacturing economics significantly.
Right.
Furthermore, we just saw a federal court block IRS efforts to restrict renewable energy tax credits. That provides a sector-wide macro tailwind that keeps the economics of clean energy highly favorable for Bloom's customers, encouraging them to actually sign these massive deals.
But I do have to raise an analytical point here. Catalysts are only really useful for an investor if they aren't already fully priced into the stock. With all these upward revisions and highly publicized macro tailwinds, how much of this good news is already baked into the current valuation? We have to wonder if the market has already fully digested these catalysts.
Now let's pivot to the chart, because the price action tells the story of exactly how much the market is priced in, and it has been nothing short of a blistering run. Year to date, the stock is up 198%.
Wow.
And over the last 12 months, it has surged approximately 1,400%.
1,400%. Look, if you are listening to this and pulling up a chart that is up 1,400% in a year, you are probably feeling a serious case of vertigo.
Right.
It goes against every rational instinct to look at a chart that parabolic and think about getting involved. I mean, it hit a 52-week high of $322.83, but recently we saw a sharp 13% pullback to an intraday low of $241.13.
Right.
I look at the stock like climbing a massive steep staircase in a full sprint. Eventually, your legs start to burn, your lungs are screaming, and you just have to stop on a landing to catch your breath. A 13% drop in a week isn't necessarily a heart attack. Sometimes it's just the stock pausing on the landing.
That's a great way to look at it.
And this is exactly where chart tools like the VIP Algo suite we mentioned earlier can really help traders visually identify those structural support levels during these volatile, scary pullbacks. Because when a stock drops that fast, you need to know if the staircase is crumbling or if the market is just breathing.
And if we translate the chart data into human psychology, looking at the moving averages, it is just breathing. The stock is currently sitting in a posture we call below the short term, above the intermediate term. To put real numbers to it, it's trading about 6.3% below its 20-day simple moving average, but it remains safely 12.7% above its 50-day simple moving average.
So practically speaking, what does that actually mean for the people buying and selling?
It means the short-term traders, like the ones who bought a few weeks ago, they're feeling the heat and taking their profits off the table. That pushes the price below the 20-day line. But the long-term institutional buyers, the heavy hitters who bought in months ago, they're holding tight and maintaining the floor, which keeps it well above the 50-day line.
Ah, I see.
So it's a healthy consolidation phase rather than a structural trend reversal. Momentum and growth are doing the heavy lifting, but the market inevitably needs to periodically digest massive gains.
So what does market sentiment look like? Because a chart is essentially just human emotion translated into lines and candles. What are the big players actually saying?
The analyst mood is overwhelmingly positive right now. Out of 16 covering brokers, 14 rate the stock a buy. We're seeing major price target hikes across the board to try and keep up with the price action. Royal Bank of Canada reiterated their outperform rating with a $335 target. Bear boosted their target to $242. Wells Fargo bumped theirs up to $217.
And the broader market narrative seems entirely captivated by these massive deals they're signing. I mean, I'm looking at the expanded 2.8 gigawatt partnership with Oracle and a massive $2.6 billion pact with Nebius Group.
Yeah, and those landmark deals are exactly what validate the technology in the eyes of the broader market. It basically proves that the biggest players in tech trust Bloom's infrastructure for their most critical operations.
But let me push back on the hype machine for a second here. We are looking at a company that now has an $81.7 billion market cap, a hardware company. Are we getting carried away with rumors? It feels like the market might be getting a bit ahead of itself.
Well, the massive market cap is actually creating a speculative catalyst all of its own. Because Bloom has surged to an $81.7 billion valuation, it is vastly outgrowing the Russell 2000 index. This creates very loud, highly speculative rumors about potential inclusion into the S&P 500.
Ah, right. Because when a stock gets added to the S&P 500, it's like a bouncer suddenly opening the velvet rope at an exclusive club. Every passive index fund and institutional manager tracking the S&P 500 is legally forced to step inside and buy shares, completely, regardless of the current stock price.
Exactly. It creates an artificial wave of forced passive institutional buying. Add in the constant whispers of more unnamed Tier 1 hyperscaler mega deals in the pipeline, and you have a sentiment environment that is highly speculative, yes, but deeply bullish. Now let's talk about the risks, because look, no stock goes up 1,400% without a few skeletons in the closet, and we really need to look hard at the downside.
Absolutely.
The most glaring risk right now is pipeline vulnerability. We just saw a specific example of this that actually caused a 6% single-day drop in the stock. Crusoe Energy, a key partner, unexpectedly halted the development of a 1.8 gigawatt data center facility that was directly linked to Bloom's fuel cell contracts.
So this basically exposes a flaw in their 90-day advantage. I mean, even if Bloom can manufacture and deliver their generators in 90 days, if the customer's overall data center project gets delayed by, say, local permitting or fighting over water rights for their cooling towers or zoning issues with the city council, Bloom's revenue gets delayed too. They are completely chained to the slowest moving part of their customer's construction site.
Precisely. If the customer can't break ground on the building, they can't take delivery of the power cells. That puts a meaningful portion of Bloom's anticipated revenue at risk of delay at any given time. Wall Street analysts generally shook off the Crusoe energy news, noting that the massive Oracle and Nebius deals remained fully intact. But it perfectly highlights the execution risk inherent in physical construction.
And I have to hammer home the valuation reality here as another massive risk. Shares are currently trading at a 143 forward price-to-earnings ratio. They're sitting roughly 11% above the analyst target midpoint. When you trade at a 143 forward PE, near flawless execution is fully priced in. The market is not leaving any room for error. If one of these massive pillar deals like Oracle or Nebius shows even a slight crack, a delay, or a renegotiation, the multiple contraction on this stock will be violent and severe.
That is a very real threat, particularly for value investors. You're paying a steep premium. However, to balance that nuance, you do have to look at the velocity of their earnings growth.
Yeah.
Analysts project that earnings per share will roughly double, going from $2.13 in 2026 to a consensus of $4.35 in 2027.
Which is huge.
Right. If management simply executes on their existing backlog without any major hiccups, that sky-high PE ratio is going to compress very rapidly. It's an undeniably expensive stock today, but they are growing into that valuation at an astonishing speed.
So with everything on the table, what's the final verdict?
Based on the underlying analysis of their growth trajectory versus the pipeline risks, we arrive at a bullish score of 8 out of 10.
Okay.
The final stance here is a speculative, high-growth bullish outlook. This is strictly for investors looking for a multi-year, think a 1 to 3 year horizon, who really want to ride the AI power infrastructure supercycle. It is highly appealing for growth investors who want to benefit from the operating leverage of Bloom's recurring service revenue and their incredible 90-day deployment speed. However, value investors should remain very cautious. That 143x forward PE means the main downside is pipeline execution risk. Any macro downturns or specific customer project delays will punish the stock price heavily.
It is a phenomenal story of a company laying the tracks right in front of the AI bullet train, but you are absolutely paying a premium ticket price to get on board.
Yeah.
And as a clear reminder to you listening, this analysis is strictly for educational purposes and is not financial advice. You must not treat this as a recommendation to buy or sell any security.
The AI infrastructure build-out is going to take years, and the companies solving the physical bottlenecks like providing reliable off-grid power are the ones holding the keys to the future of the industry.
And if you want a cleaner way to read trading charts to navigate the volatility of fast-moving stocks like this, check out VIP Algos. The link is below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSO planning areas.
Yeah, it's super helpful.
It really is. It helps make scanning your charts easier. But remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading always involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
When the dust finally settles on the artificial intelligence revolution, it might not be the smartest software algorithms that won the day, but the unglamorous companies that figured out how to keep the lights from going out. Something to think about.